What up, YouTube? It's your boy Charles Enoch. You already know we back with another episode of Investor Myself. So roll the intro. So like you guys already know, before we get started, your boy got to do the YouTube thing. So my goal is to reach 10,000 subscribers by the end of this year. I know it's a crazy goal, but it's my goal. So let's make this thing happen. So if you're new to the channel, go ahead, take a little bit of time, hit that subscribe button for me. And also, don't forget to smash the like button and leave a comment as well. I appreciate anybody that does all these things because it does help me reach a broader audience base. So as you can see, I got my Jayhawk gear on today. They play today, but the video will be posted tomorrow. So hopefully they get the dub and I don't look silly wearing my Jayhawk shirt. All right, so let's get to it, man. A couple weeks ago, one of my younger cousins hit me up and asked me how he can pay off all his credit cards quickly. He's in his early 20s. You know how that goes. Get a hold of a credit card or two, start charging it up on things that aren't investments and can make you more money. And then you just look up one day and you're in a pile of debt, right? Now, I told him to fill out one of my forms and I haven't heard back from him yet, but I get it. Young man got things going on. I know he got his real estate license, working a couple jobs, probably just really busy. You know, you got to get your grind on. So today I decided to go over how can you pay off multiple credit cards using Velocity Banking. Now, in this example, we'll be using a line of credit to pay off all of our credit cards. And this will pretty much free us up cash flow since the credit cards are paid off. Once we do that, we will then use our line of credit as our checking account. So we're going to be putting all our income into the line of credit and drawing whatever we need out for expenses. Now, as long as we have a consistent cash flow, meaning that your income is more than your debt, the money that remains on the line of credit will be paying your line of credit off. Now, I know this may sound complicated, but you already know I got the whiteboard in the back. So let's get started. Let's go. All right, so on the whiteboard, you already know we get down to business here. So let's take a look at this example. So we're going to have an individual here. Their income is going to be $5,000 a month. Their expenses are going to be $4,600. And they're going to be left over with a cash flow of $400. Again, cash flow is going to be your income minus your expenses. So this is what you bring home at the end of the day after you pay all your bills, right? So this individual is going to have 5 credit cards here. So credit card one is going to have $1,000. Interest is going to be 25%. And the minimum payment that they have to pay per month is $75. This will also be the same for credit card 2. Same balance, $1,000. Keep it simple, 25% interest, and the minimum is going to be $75. Now, credit card 3 through credit card 5, they're going to have $500 on it. The interest is going to be 20%, and the minimum payment per each card is going to be $50 per month. So they're pretty much minimally paying $300 per month on credit card debt. Now, this individual, let's say, went to the bank, they got approved for a line of credit for $7,000, and the interest rate on that line of credit is going to be 10%. So we're going to see how we're going to use Velocity Banking to use our line of credit to pay our credit cards and how we're going to pay the line of credit off quickly. All right, so we're on the other side of the board. So let's break this thing down and see how we're going to be using the Velocity Banking. So the first step that we're going to do when we get our line of credit, remember it is $7,000 that we have on our line of credit, right? So we're going to use $3,500, which is the total of all our credit card balances put together. We're going to take $3,500 out of our line of credit to pay off all our credit cards. So when we pay off all our credit cards, what this does is it is going to decrease our expenses and increase our cash flow. And it's going to increase our cash flow by $300 and decrease our expenses by $300. And why is that? Because the minimum payment on all our credit cards totaled $300. Since we don't have any credit card debt anymore, then we don't have to pay that minimum payment, which increases our cash flow. So that'd be step number one. Now, step number two, we're going to take our income. We're going to take $3,500 of our income. No matter how you get it, if you get it weekly, bi-weekly, when you get $3,500, or pretty much when your check drops, you're going to be putting that into your line of credit. $3,500 will fill your line of credit back up to $7,000, back to full. Now, the next step of what you're going to do, you're going to reuse the remainder of your income, $1,500, because remember, this individual gets $5,000 every single month. So you're going to use the remaining of your income to pay some of your expenses. Now, remember, our expenses were $4,600. Since we don't have any credit card debt, our expenses go down to $4,300. So if we do the $1,500 minus that, we get $2,800 left in expenses. Now, how are we going to pay our expenses? Easy. We are going to use our line of credit. Remember, we paid our line of credit back up to full with our own income. So we're going to use that $7,000. We're going to take $2,800 of it out of that $7,000, and then we're going to be left with a balance of $4,200 that remains on our line of credit that we can use. So let's look at the month of January and what transpired here. So we have a remainder amount of $4,200, which means that we have a balance of $2,800 that we owe back onto our line of credit. Now, the debt on the credit card is zero because we paid that off in full. All right, so now we're on the month of February here. So the first thing we have to do is look at our remainder balance for the end of January, which is $4,200. So this first step, we're done with that because we paid off all our credit cards. So we're going to be focusing on this step now. We're going to take $2,800 of our $5,000 in income to pay off our line of credit. Remember, we got $4,200. We had a debt of $2,800. So we're going to take the $2,800, put it on the line of credit. We're going to pay that thing back up to full. Now, once we do that, we're going to take our remainder money, which is going to be $2,200. We're going to put that towards some of our expenses. Now, if we do the math here, we're going to have $2,100 remaining for expenses. And how are we going to pay the expenses? Again, we're going to use our line of credit. So we're going to use $7,000. We're going to take out $2,100 to pay our expenses, which leaves us with a remainder balance of $4,900. So let's look at the end of February here. We have a remainder amount of $4,900 on the line of credit that we could use. And then we have a debt balance of $2,100. So we can see that the debt balance is slowly going down here, right? So our cash flow increased from $400 to $700 because when we paid off our credit cards, it gave us $300 of cash flow. So if we're doing the math here, our debt is going down by $700 every single month. All right, so we're in the month of March. First thing we got to do is see what happened at the end of February here. So we have a debt of $2,100 on our line of credit. So we want to pay that off in full. That's our first step. So we're going to use our income. We get $5,000 a month. We're going to use $2,100 of that to fill back up our line of credit, paid in full, right? Second step, we're going to use our remaining income of $2,900, put that towards part of our expenses. We do the math, we have $1,400 left in expenses. Now again, at this point, we know that we're going to be using our line of credit, that $7,000. We'll be pulling out $1,400 to pay the remainder expenses, and the remaining amount that we have on our line of credit will be $5,600. So let's look at the month of March here. So again, the remaining balance, the money that we have to spend on the line of credit or use is $5,600. The debt that we need to pay off to fill it back up to full is $1,400. And again, we know the debt on the credit card is zero because we paid it off with our line of credit. All right, so we're in the month of April. So we know first step that we need to do, let's see how we ended on the month of March here. So our debt balance on the line of credit is $1,400. We're gonna use $1,400 of our income that we get monthly, the $5,000, and we're gonna put that towards the line of credit, fill that thing up to full, back up to the $7,000. Second thing is, we'll use our remainder income, $3,600, and we're gonna be paying majority of our expenses. We're gonna be left with $700 if we do the math there, right? And again, at this stage, we know we're gonna use our line of credit. We're gonna pull out $700 out of our line of credit, and then we'll have $6,300 remaining on our line of credit. So let's see how that looks for the month of April here. So the remaining amount, we have $6,300 that we could potentially use just in case of emergency or anything, right? And then our debt balance on the line of credit is $700. All right, we're on the last month, the month of May, the perfect month. It's my birthday month, so let's get this thing completed here. So the first step that we have to do, see how we ended in April here. So we see we have a debt of $700 for April. So the first step we're gonna do, use our income. We're gonna put $700 back onto the line of credit, pay that thing up to full. Now our next step is use our remainder income, which is gonna be $4,300. Guess what? Enough to pay all the expenses. So once we pay all the expenses, it's a big fat zero. And we look at our next step, we got $7,000 in our line of credit, zero expenses that need to be paid. So the balance on our line of credit, it should say $700, but our debt on our line of credit is $0. So we're looking here, we have a balance of $7,000. Our debt is zero for the line of credit. Debt has been zero for our credit card. So this would be a velocity banking method to pretty much consolidate, basically using our line of credit to pay off all those credit cards, free up our cash flow. Then we use our line of credit like our bank account. Every time we get a check, we put it back into that line of credit. When we need to pay something, we just draw the money out and then we pay for it. Now, the one thing to note here, with the line of credit, it does get charged by daily interest. So you want to keep your check parked into the line of credit as much as you can. Only draw the money out when you need the money, but keep it in there here. Now, for those that don't know how to calculate simple interest, I do have several videos about that. I will leave a video in the description down below if you don't know how that works. So I hope this video was informative. If it was, please remember to subscribe to the channel, hit that like button, and leave a comment for your boy. It does help me reach a higher audience base. And hopefully my Jayhawks win today and you guys have a good weekend. Peace out.